What's going on, guys? In this video, I'm going to show you another really cool free tool that you can find on the internet. A link will be in the description. It is not this, but this is what I'm going to show you to start the video. This is the tool, a backtest portfolio asset allocation tool, where we can plug in all this great information and then compare different types of portfolios. Because if you're new to investing, or maybe you are seasoned and you're always trying to figure out what is the best way to get alpha, what's the best way to beat the market, or just get the best possible return. And you can see right here, this is all different types of asset allocation diversifications over the past 20 years, ranked from best to worst. And one thing that we could all confidently say about this is there is no pattern whatsoever here. It's all over the place. You could look in 2018, cash was actually the best investment. A few years, large cap stocks have been the best investment. But then you could look, back here, large cap was actually one of the worst investments, or just one of the bottom half. Another one that's second to worst. So it's just kind of all over the place. But I think right here is the most important column, your annualized return. So you could see over the past 20 years of this graph or chart, whatever you want to call it, you could see that on average, large cap growth stocks did around a little over 10%. Same with REITs, small to mid cap. Then you got large cap value. You get into that 8% diversified portfolio. That's when you're going to be including stocks and bonds, around 7.78. International, global bonds, commodities, and then at the bottom is cash. So there is kind of a rhyme and reason here, but if you're going to try to cherry pick just one year, there's no saying what could actually be the best, because you can see it's all over the place. Just like in 2018, cash was the best investment. 2021, REITs were the best. 2020, large cap stocks. 2016 was small cap. 2011 was bonds. So it's all over the place. But again, like I said, there's there's some kind of rhyme and reason to all of this. And it really comes down to backtesting. Now, even though backtesting does not prove future success, I still think it's important, just so you can get an idea of what to expect in the market. So let's go over this tool. It's really fun to play with. Again, link will be in the description. But for the first column, time period, we're going to keep, year to year. Start date, I'll bring it up a little. How about the last 20 years? So we'll start at 2002. It's 2002 to 2022. Do we want to include year to date? Sure, why not? And then initial amount, we'll say 10,000. We're going to keep everything basic at first, and then we'll come back and mess around with it. You can see that, all right, we have rebalance annually, no cash flow, no leverage type. Reinvest dividends, that's a big one. We'll keep that. And we could put in our own ticker symbols, which we will. But before that, let's just see what we have. So you can see we got, how do we want our allocations? We could import a portfolio. But then here's all of the lazy portfolios. Just your standard growth, moderate, conservative, income, all of these different famous investors, and then your standard stocks to bonds 60-40 or stocks to bonds 40-60. So let's throw that in, and you can see it will put in a couple of indexes for us. So there's a stock market index, there is a bond market index. Let's jump over to portfolio 2. And what's cool is, all right, we can compare it to maybe one of these famous investors. How about Ray Dalio, All Seasons? So we're going to compare his portfolio to the 60-40 split. And we'll leave it like that for now. We're going to hit Analyze Portfolios. And then you could see when you scroll down, this will show results from 2007 to 2022. That's just probably because one of these indexes weren't a thing until 2007. So it has to keep it fair and have the exact same start time. But you can see here was our 60-40 split. Here's Ray Dalio's split. And then what's cool is here's portfolio and portfolio 1 and 2. Initial balance, both $10,000 each. And then we can see the final balance. So the 40-60 split was a little over 29,000. and then Ray Dalio's was a little over 28,000. So overall, the 60-40 split performed better. And what's cool is we also have our CAGR. So you can see right here, 7.18%. And we can also look at inflation adjusted. So inflation adjusted, it's a true 4.57%. And then this is a true 4.27%. And what's nice is you got the chart, obviously. I think this is, you have the option. Do we want to do logarithmic? Do we want to do inflation adjusted? Just so you get an idea. I think inflation adjusted is important. And you can see best year, worst year, max drawdown, your Sharpe ratio, all this good stuff. And then down here, here's all of your years kind of in a nice little graph. And then you have all of your returns. So you can see what your 3-month, year to date, year, 3, 5, 10, full, and then your annualized standard deviation. And then this is just important notes or whatever. But let's start to, well, before we mess around, I think this is important, a benchmark. So let's throw in the S&P 500, because how are we doing compared to if you were to just throw it into something like the SPY? Let's hit analyze, and not surprising at all, you're better off just throwing into the SPY instead of trying to get fancy with stuff, because both these portfolios did not perform anywhere nearly as well as the S&P 500. The S&P 500 had a return of 9.16%, or inflation adjusted 6.5%. But we could do a lot more. One thing that I think is cool is you're not going to just throw $10,000 in and then forget about it for the next 20 years. You're probably going to continue to contribute, and you may think, well, hold on. If I'm in stuff that's a little bit more volatile, I'm going to be buying at these very low prices, and then obviously you'll be buying at these highs, but that may change what's going on here. You could add that. So if we go up here to cash flows, we're going to have contribute fixed amount, withdraw fixed amount, whatever it might be. So we're going to do contribute fixed amount, and we'll say, how about an extra $500 each month? So maybe it's an IRA. You could put a total of $6,000 in a year, or $500 a month, and you already have $10,000 sitting there. Or we could even say you only have $6,000. So you have your first year done, $6,000. Now you can continue to contribute $500 each month. Let's hit analyze portfolios. And we'll get rid of logarithmic. We'll turn on inflation adjusted. And it does look kind of similar. Don't be confused. You're not getting 26% annual return. This is just adding that additional $500 that you're adding each month. So that's why it looks so much higher. But you can see you're going to be getting around the same scenario here, where the 60-40 did better than Ray Dalio's, but the regular stock market beat both of them. And again, here's all of your years in a nice little graph. But now we could get creative. So maybe we want to get rid of this, forget about Ray Dalio's, and we want to come up with our own portfolio and see how that's going to do. Now, if you know me, I'm not the biggest fan of bonds. I do not own any bonds, and I really don't care for them. I just have stocks, index funds, and Bitcoin, and that's about it. So let's say I want to invest in the SPY. So there it is. I want to invest in the NASDAQ. So there it is. And then recently, I've been liking so I lied. REITs are the other thing. So I'm starting to like REITs because I could see their potential. So maybe I have something that looks like this, right? So the SPY, the Qs, and then Realty Income Corp, or ticker symbol O. So let's say for the SPY, I have 50%. Qs, I have 25%. And then O, I also have 25%. So there's my 100% allocation versus the 60-40. We hit analyze, and remember, we also have the S&P 500 in this as well. Let's get rid of logarithmic. So you can see that if you were to invest in the SPY, the Qs, and ticker symbol O, that actually performed better than the stock market over the past 20 years. So you could get creative. We could just blow everything out of the water and add Tesla. And let's say this is only 15%, and then the Tesla is 10%. And then we're probably going to be way out of the water here. Get rid of log. Yeah, you can see we're super high because of that Tesla position. But, don't think, oh, I own Tesla, so I'm going to make all this money, because, again, past results are not going to determine future results. And I think that's really important. I really don't think this is the best thing to use when you're talking about individual stocks. It may even be a little unfair using REITs. I would say if you're actually going to use this to come up with some kind of strategy, it should really only be index based. It should not be stock based, because again, I could throw Tesla or Apple or Nvidia up here and it's going to beat every single portfolio. But just because all of those companies 100x'd over the past decade doesn't mean it's going to go up another 100 times. It's highly unlikely that's going to happen. They're now much more matured companies. They're probably going to perform alongside with the market, like the SPY, or it may actually perform below the market. It may not do as well. So again, you really can't compare individual stocks in this scenario, and I wouldn't do that. I don't think that would do much justice to you. But let's get rid of this stuff again. You could also see, maybe you're someone, you want to open up a 401k with your company, and you want to know, okay, what's the difference between if I had a growth or a moderate portfolio? So what's the difference between growth and moderate? Let's see what that looks like. You scroll down, get rid of log, and then you can see, okay, so there's the S&P 500 in green. So that is higher than the rest. But then you can see right here, portfolio 2 and 3, right? That's going to be your aggressive and then your moderate. They're kind of in line. Obviously, the aggressive is a little bit higher, but that blue line, don't forget about that blue line. That's the 60-40 split. And it looks like that does even better than aggressive. So maybe you don't even need to get that fancy. And let's actually get rid of our moderate, because I think that's something important people should realize. People will knock the 60-40, but it's reason that that's been the standard for such a long time. Let's just not have any benchmark, just so we can really look at the difference between the 60-40 split and then an aggressive split. And you can see right here, you're pretty much hand in hand. I mean, the 60-40 is doing a hair better. We're getting just a little bit higher with the 60-40 split. And again, this is if we're contributing money each month. So that $500 a month, you're doing just a little bit better. We got 22.41 as opposed to 22.32. So you really don't even need to get this fancy. You don't need to hold on to 4 different indexes when 2 is going to get the job done. Just your basic Vanguard stock market index and then your Vanguard total bond market index. And then you're set. That's all you need. Again, if you're more open to higher risk, then I would recommend drop the bonds. Just hold on to 100% stocks, especially if you're younger. You could afford to be a little bit more aggressive. Again, that's not financial advice, but that's going to beat, pretty much anything. Just holding on to the benchmark. Really, nothing could beat the benchmark, at least in all these examples. I actually went through every single one of these to see if any of them over the past 20 years have beat the S&P 500. And with no surprise to me, they have not. So you can test it out yourself. But again, that is portfoliovisualizer.com. A link will be in the description. A really fun back testing tool to see what's the best way to allocate your funds. Guys, if you like this video, make sure to smash that like button. And as always, I will see you in the next one.